Coming up today, stocks continue their pullback. What Wall Street sees happening next year. Inflation breaks out. The Fed set to cut rates next week. Washington dialing up a trade war. And are we going to get a Santa rally in stocks next week? Let's go, guys. And welcome back to the Daily Market Review, everybody. What's been a pretty soft start to the month of December, especially looking at most stocks like the Russell 2000. In fact, it's closed lower than when it opened 12 out of the last 13 sessions. And just looking underneath the hood at some spreads, the S&P 500 equal weight versus the S&P, it's come off really hard the last couple of weeks. Just like the NASDAQ equal weight versus the NASDAQ, mid caps versus large caps, and the Russell versus the S&P as well. Most stocks underperforming the index here. However, the good news is we've got some bullish seasonality coming in, not only on the spread, the relative difference between small caps and large caps for the next 2 weeks and the next month, but also just outright on the Russell 2000 as well. Typically, the second half of December performs better than the first half, and it's usually small caps leading that way as well. So we'll be looking for a bit of a bounce in small caps next week for seasonality to play out. However, I'll get a bit more into that in a minute. But just before we move on, next week is the last full week of trading before Christmas, in which the stock exchange closes early on the 24th, completely closed on the 25th, and trading and news flow really slows down around this time of year into the new year as well. So I'll be taking some time off from making the daily market review from the 23rd of December to the 22nd of January to give myself a bit of a break and spend some time with family and friends, as I haven't had any time off all year, so I'm sure my regular viewers can appreciate this. And to my paying members, please rest assured, I will still be monitoring the market daily and managing my stock picks and swing alerts portfolios as per usual. So nothing changes there. I will just not be making a daily market review video for a few weeks, but we'll definitely be back to doing them every day from the 22nd of January. So just to sum up, I'll be back next week with a daily market review every day for the last full week of trading this year before taking a few weeks off over Christmas into the new year. And I just want to say a big thanks to everybody who's stuck with me all year, and I'm really excited to see what next year brings for us all. And as we are approaching the end of the year, we're starting to get forecasts coming in for next year from across Wall Street banks. Overall pretty bullish, as just about every single one of them came in a lot lower in their forecast this year compared to where we've ended up. And so looking out to next year, they may not make the same mistake twice. We've got Wells Fargo 7,000 along with Deutsche Bank, Fundstrat 6,600, Goldman Sachs 6,500, JP Morgan 6,500. Way out down the bottom there, BCA Research 4,450. And why they're so much more bearish than the rest of the street, thinking the S&P is going to decline 26%, they expect global economic growth to slow sharply next year, in part driven by a major global trade war. And they think the US consumer will finally buckle. Also a little bearish, Stifel, pointing to stock market valuations at extremes and calling this the fifth mania over 150 years of trading. Goldman Sachs a little bit more bullish though. They see corporate profits jumping 11% next year on the back of a continued expansion in the US economy. They think GDP will grow at about 2.5% next year. Mike Wilson from Morgan Stanley, also a little bullish as well. He's previously been a skeptic of this bull market, but he thinks these rich valuations could be justified as long as the economy holds up. JP Morgan says US equities should remain supported by the expanding business cycle, US exceptionalism that is helping broaden the AI cycle and earnings growth, ongoing easing by global central banks, and the wind down of the Fed's quantitative tightening in Q1. Fundstrat also bullish, but they see it as a tale of 2 years, thinking we're going to do really well in the first half of the year before pulling back in Q3, and kind of similar narratives coming out from across a bunch of other banks as well. Most of them are expecting corporate profits to hold up, the economy to hold up, but pointing to risks from tariffs, inflation. But one of the most bullish, and who actually had the closest forecast to this year, Ed Yardeni. He thinks the roaring 20s will continue next year. He thinks we're going to hit 7,000 on the back of a new pro-business government, and he thinks animal spirits could be unleashed on the market. But a big part of this current bull market, not only the last 15 years, but it's really accelerated the last couple of years, is the huge amount of buybacks, mega cap tech, absolute cash machines. And just looking at overall buybacks in the S&P in the third quarter, $235 billion, almost $250 billion, depleting the supply of shares out there, with Apple leading the charge, having done $96.3 billion in buybacks in the last 12 months, 440 over the past 5 years, 687 over the past 10 years. And so just looking at a long-term monthly chart of Apple, they've pretty much had flatline revenue in these last 3-4 years. In other words, they've had zero growth, but the stock price has more than doubled thanks to those huge corporate buybacks, which again is a really tough thing for anyone who wants to short into that, because you could be right on your business forecast, but then they're piling hundreds of billions of dollars into decreasing the amount of shares on the register. But that's also part of the reason Apple hasn't innovated as much. The world's largest company hasn't really created any breakthrough technology for years. They kind of just use what's already out there and slap the Apple logo on it. But that's good enough for the market, and that's why it's still trading at all-time highs. And it's kind of crazy to see a company the size of Apple with zero growth trading at 10 times sales. Maybe a big reason why Warren Buffett offloaded over half of his position in the stock this year. It's at record valuation. Still uncertain whether they can get back to double-digit growth. Another thing we'll be looking for next year is whether value can make a comeback. And I'd say for that to happen, we'd really need to see growth pull back. Typically see value outperform in soft markets, bear markets. As investor sentiment shifts from being really excited about growth, willing to pay any valuation, to being a bit more discerning and looking for good valuations, good yields, solid earners. There's a look at a long-term spread chart of the Vanguard Value ETF versus the Vanguard Growth ETF, which has been in a secular bear market for quite some time now. It's really 2022 that it outperformed there while the main indices took a pullback. But here we are today, breaking down to new lows. And so is the stock market Santa or the stock market Grinch going to show up next week and into Christmas? Goldman Sachs thinks there's going to be record inflows into US stocks, and we will get a Santa Claus rally in the last days of 2024. And that's been another theme in the market this year. Huge inflows into US stocks, actually seen net outflows from international stocks ever since the election. US equity markets logged a record 186 billion worth of inflows just in the last 9 weeks. It'll be interesting to see when the Fed decides to go on pause next year. I think it's highly likely, maybe even in Q1, and maybe at first unofficially announce they're on pause, kind of wait and see what happens. The economy has held up a lot better than what many people were forecasting at the start of the year. A few months ago, we had a bit of a scare in the jobs market, unemployment rate ticking up. That seems to have kind of just held ground. Inflation has cooled a lot for most of this year, kind of set up a soft landing scenario. We've still got the economy and corporate profits growing, whilst inflation's coming down, allowed the Fed to start trimming rates. But I was just looking over at the Trueflation US Inflation Index, which in my opinion gives a much better reading on inflation than the government printed CPI, because they're looking at a wide range of data, including straight from the websites of large retailers, so on and so forth, hence the name Trueflation. Look at this over the last month, 2.74. Here we are running at an annualized rate of 311 today. Just going out to the last 6 months. Ever since the Fed cut, inflation's just shot right up, and just going out to a yearly chart, we've just broken out to a new yearly high. In other words, inflation's uptrending. We've just broken out here and just going out again to the max chart, still obviously well off those 2022 highs, 11%. You can see how quickly inflation goes vertical, like it did straight out of the gate in 2021. Kind of amazing the stock market held up in 2021. Didn't really start rolling over at the index level until December. Although if you were looking underneath the hood at market breadth, many stocks started rolling over in Q2, Q3 in 2021. We could see that in market breadth. However, like I've been saying, inflation may have found a bit of a floor. Maybe a while before we see a one handle on inflation again. I think we'd really need a recession to get that. And we've noticed that of late in food prices. Eggs, beef, and other necessities still increasing more than 3-4% a year. It's really the discretionary items that are helping to bring down the overall CPI prints that we're getting into the low 3s, high 2s. But we can see that in the markets as well. Agricultural Fund ETF, DBA, in a pretty solid uptrend here, and just going out to a monthly chart on it. That pulled back somewhat in 2022 as well. However, I think it's fair to say that agricultural commodities could be in a pretty decent bull market here. And the thing with commodities, bull markets can go on for a long time, just like the bear markets can as well. So this is definitely upside pressure on inflation. And once again, we're getting a little bit of an uptick in inflation-protected treasuries and the spread of commodities versus long-dated treasuries as well. So I'd say at this stage, there's probably more upside risks next year in inflation than there is in downside risks in recessions. Of course, things can change quickly in the economy and markets. However, for the here and now, animal spirits are running high. The economy is on firm footing, and too much of a good thing could definitely get prices heating up. And we're seeing a pretty significant bounce back in the 10-year yield this week, probably adding a little bit of pressure to the stock market as well. Not to mention a little bit of a bump up in crude oil futures, but not too much. But even in the light of all that, the Fed is still looking set to cut rates next week when they meet on Wednesday for the last time for the year. More interesting will be Jay Powell's language, whether he gives us any indication he's ready to go on pause. If I was him, I'm not even sure I would do another cut next week. I think he's almost ready to go on pause now. Just looking at trueflation and market pricing, not to mention current readings on the consumer, other economic data points, markets trading pretty firm, credit spreads really low. I don't really see the pressing need to loosen monetary policy here. Not really sure whether the economy needs any more stimulating. However, interest rate traders are certain he is going to cut on Wednesday, 97% chance. But after that, they only see 2 more cuts next year, one in March and another one in September. I think Jay Powell might be done at 375. But again, if those inflation readings keep ticking up, this indeed may be the last cut of this cycle. Kind of hard to justify stimulating the economy with the stock market at all-time highs. Now got a big bounce back in trueflation above 3%. Not to mention we saw PPI come in double what economists were forecasting this week. And many parts of the market still trading hot, We just saw Broadcom today, joining the $1 trillion club for the first time on the back of their earnings results today. Only coming in with a slight beat, $1.42 versus $1.39 expected. Revenue actually came in line, forecast a little bit better than expected, but they said the AI opportunity for them is massive, noting the company has 3 hyperscaler customers and they still see plenty of growth on the horizon. And so does the market. Look at that. Just for a slight beat on a massive company, up 24% today, brand new all-time highs. You guys remember a few months back, Nancy Pelosi and her husband loading up on call options, as this company is headquartered just down the road from where they live. But don't worry, I'm sure they didn't have any insider info. I guess they just got lucky for the 100th time in a row. And there's a look at the $1 trillion club as it currently stands. We now got 10 stocks in there, all of them American, bar 2, Saudi Aramco, world's largest oil company, and Taiwan Semi. Now meaning 3 of the top 10 companies are chip makers, Broadcom, Taiwan Semi, Nvidia, and all but 2 companies are tech related, Saudi Aramco and Tesla, even though one could make an argument that Tesla is a tech company, or should I say, is more becoming an AI robotics tech company in addition to their clean energy products. So again, it'll be interesting to see how the AI trade does next year. It's been super hot this last 2 years, ever since the launch of ChatGPT, and also be interesting to see whether all these big CapEx spenders can turn their huge investments and R&D into AI and all their NVIDIA GPUs into profitable products. Many of them have not just yet. But overall, I still see the secular trend of AI there. I'm a heavy AI user myself. Can't really see that going away anytime soon. It's just the market's valuation and how excited they feel about the future. That's more of the question. And also playing into that theme is how a potential nasty trade war between the world's 2 largest economies, the States and China, plays out next year. We just heard more today from Washington. They're planning rules limiting semiconductor shipments to other countries accused of supplying Beijing, as China's apparently been using some backdoors to get their hands on these advanced AI chips. And so you could think of semiconductor chips as the modern day oil. Decades ago, countries were fighting over oil. That was the big theme. The Middle East had much more sway over the global supply of oil. Now the States is the #1 producer. That's not so much as a risk of getting another oil embargo, like what happened back in the 70s. It's more about semiconductor chips nowadays, which pretty much our economies run on. And so like we've already seen, China's not just going to sit there and take it. They will retaliate, and they do have some leverage when it comes to rare earth metals, which are vital to the US industry. We just heard Trump invite Xi Jinping to his inauguration, maybe trying to start off on a good note, but we don't know exactly what sort of tariffs he's going to do, and maybe there could be a little bit of a grace period where he doesn't do it from day one, but maybe takes a few months. China could also bite back by continuing to dump more US treasuries, damaging the market of US debt securities. A lot of people don't realize it's the Japanese and Chinese that buy most of the state's debt. And that also plays into whether the US will start a national Bitcoin reserve, run the price up to Bitcoin into the millions, could simply just cash it in, pay off all the US debt. Wonder how China's going to feel about all that. So this could all still play out next year. Could turn out to be a nothing burger, or it could potentially turn out to be the worst trade war the world's ever seen, which no doubt would create a lot of volatility in financial markets. And apart from the US, the rest of the world still a little soft. We actually just heard the United Kingdom today, their economy unexpectedly contracted in October, just slightly by 0.1%, marking the 2nd consecutive monthly downturn, as the United Kingdom and the greater Eurozone just can't seem to get back to decent growth. Lack of innovation, too much regulation, too much tax, not to mention a slew of woke policies destroying the fabric and values those countries are built on, not to mention the negative economic effects from them as well. And so again, it's an interesting setup if the US economy keeps growing really well. But if China and Europe doesn't, we may actually see the floor in oil fall out, which could actually be a further tailwind for the States and consumer spending, especially if the Middle Eastern wars are dialed down and AI technology helps to drive down the cost to get oil out of the ground. And once again, we're seeing what looks to be a bit of confusion in markets, gold bumping around up and down. And apart from agricultural commodities, the whole commodity complex, largely driven by oil, it's kind of been consolidating for most of the year here, actually, just going sideways. But then we've got some agricultural commodities like cocoa just absolutely ripping, which coffee was of late as well, just having a bit of a pullback this week. And there's a look at China also pulling back after having a huge gap up to start the week. Like the market got a little ahead of its skis there, because markets hate uncertainty, and I'd still say we have a lot of uncertainty around the China trade. And even though we've got most stocks pulling back this week, we've still got some really hot parts of the market. SoundHound AI just won't give up 23% today, again on monster volume. Even though the biggest AI stock out there, Nvidia, finished the week lower. Other small stocks, Serve Robotics, finishing higher today, same with a bunch of EV toll stocks, Archer Aviation, Quantum Computing, not ready to give up either after we had that big news this week on Google's Willow chip making a breakthrough in computing power. D-Wave Quantum up 27% today. One of the biggest ones out there, IonQ, also holding on to its uptrend. There's Rocket Lab in the space exploration industry and some drone makers as well. Red Cat Holdings reclaiming its 50-day VWAP. We get their earnings next week. And so those hot pockets of the market still holding on this week. But overall, look at that breadth up the front. Every single sector, most stocks well and truly underneath their 5-day moving average. Same deal with the 20-day except for tech. 52% of technology stocks above their 20-day. Looking at the 50-day financials holding up the best. Same with the 200-day, given the highest overall score here. But really soft of late, healthcare stocks, energy, and utilities, along with REITs as well. So kind of the defensive trade pulling back. But market breadth at this point in time is pretty soft. We just did 10 consecutive days of more declining stocks than advancing. And just looking at the S&P 500 heat map for this week, we can see that stark difference. The real standouts, Tesla, once again breaking out to a brand new all-time high today. Having a great week. Alphabet, Google on the back of their new Willow chip. Apple at new all-time highs. Broadcom today. Nvidia lower, but the rest of the market pretty soft here across the board. So I'll be looking for breadth to stabilize next week if we are going to get a Santa Claus rally. Last 5 trading sessions of the year into the first 2 sessions of the year, typically a really bullish time. And like I said, more so for small caps, looking at historical seasonality. And so that'll be the big theme for next week, because typically bigger pullbacks and corrections can start like this, with persistently negative market breadth, but we do have a little bit of a rotation with the mega cap tech, so it's not completely across the board. And I'd say overall, the fundamentals and technicals of the uptrend in small caps are still intact. This may just be a little bit of a persistent pullback in the short term here. And of course, the big event next week, the Fed on Wednesday. Largely expected to cut, would be a huge surprise if they didn't. More importantly, J. Powell's language. He may give indications he could be ready to go on pause, especially looking at that trueflation reading ticking up as well. It's kind of hard to justify to keep stimulating the economy here. And overall, just looking at the VIX, option dealers not all that worried. Of course, a lot of the pricing of this is based on mega cap tech, and so at the index level, things aren't too volatile thanks to the hefty weightings of those large stocks. But bond market volatility is also low, and oil volatility has also come off these last couple of months as well. But interesting, we've got the 2-year yield climbing going into the Fed decision. So that'll be an interesting one on Wednesday. Make sure you come back for that. And like I said, I will be back next week every day for a daily market review as per usual. Then after next week, I'm going to take a few weeks off for Christmas into the new year. So thanks very much for tuning in today. I hope you have a great weekend, and I'll see you all again come Monday night. Cheers.